Hi guys, Mark Franke here, and today's lesson video is focused on chapter 22, where we are looking at internal reporting systems for companies that have multiple departments, multiple divisions, multiple regions, all kinds of different reporting groups that we can allocate expenses to. So if you take an example of a department store like a Nordstrom's has a bunch of different departments, men's shoes, women's handbags, jewelry, cosmetics. So each one of those departments is a profit center within that organization, within that particular store. And so the rent, the utilities, lots of other expenses that go into running a specific store like Nordstrom's needs to be allocated to different departments within the store. So that's what this chapter is focused on. Now, if we expand that a little bit and say, okay, well now in the Nordstrom's company, they're going to have regions where they have stores, South Coast Plaza, Cerritos, Brea, wherever they have stores in Southern California, that might be a region. And so then individual stores will roll up into a regional reporting, and then these regional reports would then flow up into the overall corporate reports. And if they have different kinds of concepts, let's take, for example, Yum Brands. Yum Brands has KFC, Taco Bell, Pizza Hut. And so these are three different concepts. And once again, they have expenses that are overall expenses that need to be allocated. So that's what this whole chapter really is focused on. I'm going to start with a simple exercise. This is exercise 22-3, and let me go ahead and put that up above here so that it's obvious. This is exercise 22-3. And what this is the Cozy Bookstore. And this is going to be called a departmental expense allocation schedule. And this is for the year ended December 31, 19 we use. So what we're doing here is we're going to allocate, they have three different departments, books, magazines, and newspapers that are profit centers. They sell books, they sell magazines, they sell newspapers. So there are support departments, the advertising department and the purchasing department, that support these two profit centers. So our job is to allocate the advertising based on sales and the purchasing expenses based on purchase orders. And so we're going to have some subsidiary schedules down below here where we do the allocation for advertising, we do the allocation for purchasing, and then we can roll these up into our main schedule. So let's get started. The total direct expense, we have advertising expense of $24,000, purchasing is $34,000. The direct expenses for the book department, this is the cost of the books, the cost of the salespeople that work in the book department, and any other specific expenses that the book department has that are unique to that department. The magazine department has the cost of the magazines, and again, sales people that work in that department, and newspapers is $125,000. So our total expense for all 5 of these categories, 3 operating departments and 2 service departments, is $698,000. So the first thing that we'll do is base the advertising expense on sales. And they've given us the sales of $495,000 for books. Let me scroll down a little bit so you can see this. $198,000 for magazines, $207,000 for newspapers. So total sales for the whole store is $900,000. And if we calculate the percentage of total sales for books, we get 55%. If we calculate it for magazines, we get 22%. And if we calculate it for newspapers, we get 23%. That total should add up to 100%. And all I did was divide the sales of each one of these departments by the total sales. And then we are allocating the $24,000 of advertising expense by multiplying that times the applicable percentage. So the allocation for books is $13,200. The allocation for magazines is $5,280. The allocation for newspapers is $5,520, and there's our $24,000. So we've done this just based on sales, and now what we can do is come up here and we're going to subtract $24,000 out of the advertising column and add it into the appropriate column up above. So books is getting $13,200 of the expense, magazines $5,280, and newspapers $5,520. And we can do the same thing for purchase orders. They gave us the purchase orders in the problem. Purchase orders for the book department was $516, for magazines $360, for newspapers $324, and the total is $1,200. So if I calculate the percentage of the total, I get 43% for the book department, 30% for the magazine department, and 27% for newspapers. $34,000 is the expense. So if I multiply times the percentage for each one of these departments, the book department is getting $16,620, magazines getting $10,200, and newspapers $91.80. This is based on a percentage of the total of these purchase orders. So now I can subtract the $34,000. Let me make this a little smaller. Yeah, there it is. Subtract $34,000 from the purchasing department, and we're going to put $14,620 in books, $10,200 in magazines, $91.80 in newspapers. So now if I total this up, I've zeroed out advertising, I've zeroed out purchasing, and then the 3 operating departments have absorbed all of the expenses from the 2 service departments so that we have them in total. So if I drop in the sales for books and the sales for magazines and the sales for newspapers, I can subtract the expenses from the sales to get profit, and then I'm going to calculate that profit percent as a percentage of sales. So the book department has 8.5% profit, magazines 46.7% profit, and newspapers 32.5% profit. Exercise 22-3. So let's move on to something that is similar. This is problem 22-1b, and this is the LMN company. And I can link this to each one of my headings because I'm going to have 3 different schedules or reports. The first one is going to be a performance report for the refrigerator department. And this is all for the month of April 2019. This is the performance report for the dishwasher department. And I'll link to, we can link text using the equal sign. And this is going to be the performance report for the Chicago plant, where the manager in the Chicago plant is responsible for the refrigerator and the dishwasher department. So the first thing we will do is prepare information on each one of these 2 operating departments, and then we will prepare the schedule for the overall Chicago plant. So here we have the budget, the actual, and the variance. We'll say over, under. The budget was $400,000. The actual, $385,000. Employee wages, $170,000. The actual, $174,700. Supplies used, $15,000. We actually used $14,000. Depreciation on the equipment was $53,000, and that's what actually was recorded. So we have $638,000 in total budgeted expense, and we spent $626,700. So if we take what we actually spent and subtract the budget, if we get a negative, that means it's under budget. If we get a positive number, it means it was over budget. So we can do it for each one of these and in total. And our total department, refrigerator department, was under budget $11,300. So I'm going to pause the video and I will do the dishwasher department. You should try to do it yourself. These are just numbers right out of the book, and I'll be right back. Okay, so hopefully you got these same numbers, and now we can prepare the overall performance report for the Chicago plant, which is going to include the refrigerator department. So I'll bring those numbers over. And the dishwasher department. See, the dishwasher department was over budget. The refrigerator department was under budget. And now we can drop in the other expenses for the Chicago plant, the budget. The total budget for the Chicago plant was $1,257,000. What they actually spent was $1,260,000, and we'll use the same thing. We're going to subtract the budget from the actual. So if we get a negative number, that's under budget. If we get a positive number, that's over budget. And I can use the drag tool to complete this. And so for the whole factory in Chicago, they were over budget, $3,900. This is just a matter of taking the information from the book, scheduling it out, the budget versus the actual. Now, the last problem I want to do is a situation where we have a company that is considering adding a department. They currently sell movies and videos, and they want to add CDs. So they've given us a bunch of information about how they're going to reallocate the expenses to these 3 departments. Currently there's only 2. They're going to add a 3rd one. So we're going to go through a little allocation process here to show what's going to happen and whether or not this is a good decision. This is a decision model. They're trying to decide, should they open up a 3rd department and in effect consolidate or move down the movie and the videos into smaller space and use the extra space for the CD department. This is called Bonanza Entertainment. And we'll call this a pro forma. Pro forma means looking forward. And this is for the year ended December 31, 2020. So we're looking at this happening going forward. And so I have prepared a template for doing these calculations. So currently, our movie department is earning $600,000. Our video department is earning $200,000. And they're saying that because there's going to be more traffic in the store if we start selling CDs, that those sales will go up 8%. So I can now link over to my schedule and calculate total sales is $1,164,000. That's what we expect to sell when we add the CD department. They just gave us the $300,000 number. Now, they told us that their cost of goods sold percent will not change for movies. So cost of goods sold in last year for movies was $420,000. Sales is up above. So the cost of goods sold percent is 70%. For videos, cost of goods sold was $154,000. Sales is up above, and their cost of goods sold percent is 77%, and they just told us that the CD department would have a 65% gross profit. Sorry, cost of goods sold percent. So if we take the sales that we calculated up above and multiply it times the 70%, we will calculate cost of goods sold for each of these three departments for the new year. So cost of goods sold for movies is going to be $453,600. Cost of goods sold for videos is $166,320, and cost of goods sold for CDs is $195. We have a total cost of goods sold of $814,920. And if we calculate individual gross profit by subtracting cost of goods sold from sales, we get a total of $349,080. And now we can do the direct expenses. So the direct expenses, these are the sales salaries of people that actually work in each one of these departments. Our movie department has salaries of $37,000, the videos is $15,000, and the CDs, they say they're going to hire people, and it'll be $18,000 in total. So that's a total of $70,000. Now we need to add the advertising, $12,500, $6,000 for videos, and $10,000 for CDs is what they expect to spend, for a total of $28,500. And we're going to do the store supplies. So they told us that store supplies, because sales is going to go up 8%, store supplies will go up 8%. So we had $4,000 in the movie department and $1,000 in the video department. We're going to ratchet that up by multiplying it times 108%. And they told us that the CD department would spend $2,000 on store supplies. So now we can link these guys in. 4320, 1,080, and 2,000 for CDs. The total expense is $7,400. They gave us depreciation expense of $4,500 for movies, $3,000 for videos, and $1,200 for CDs. If I total these up, I get total depreciation of $8,700, which means my direct expenses are $58,320 for movies, $25,080 for videos, $31,200 for CDs, for a total direct expenses of $114,600. And now we need to allocate some rent. The rent for 2019 for movies was $4,100, $9,000 for videos. We are going to move 25% to CDs. So in other words, 25% of the square footage that is currently occupied by the movie department is going to go to the CD department. So I'm going to multiply the 41,000 times negative 0.25 because I'm subtracting it, and I'm going to add it over here. So now for the CD department, sorry, for the video department, we're going to take 1/3. I'll just divide it by -3. and then bring that over. So the rent is going down in the movie and video department and up in the new CD department. I can link that in my master schedule over here, income statement. $50,000 is the total. So now we're going to allocate utilities in the exact same manner. So I'm going to take the percentage of rent in the movie department divided by total rent. That gives me 61.5%. The rent in the video department divided by total rent is 12%. And the rent in the CD department divided by the total is 26.5, and they expect the utilities to be $9,000. So we'll allocate that. And then tie it in. So we have 5535 as the the utilities for the movie department, 1,080 utilities for the video department, and 2385 is the utilities for the CD department. And then our last expense is the office expenses. And they wanted us to do that based on a percentage of sales. So if I take sales for movies divided by total sales, I get 55.7%. Videos, 18.6%. And CDs is 25.8. My expenses went up. So the total expenses that we expect for the office is 85,000. So if we multiply the 85,000 times each one of the percents, we will get 47,320, 15,773, 21,907, and the total should be the 85,000. It is. Now they've asked us to round these to 1 decimal point, so we might have a little bit of a rounding thing going. It's okay, not to worry. We'll total allocated expenses for movies is 83,605. When we add that to the direct expense, we get 141,925, and then if we subtract that from gross profit, we get 52,475. I'm going to use the drag tool to get it all totaled up. And we have a profitable CD department, so this would be a good idea. Adding the CD department will make net income go up. And that's the objective, is to maximize our profits. So that's it for chapter 22 for now. If you have any questions or comments or need some help, please reach out to me and be safe. I'll talk to you soon. Bye-bye.